We're glad to have everyone joining today's webinar. We're going to be going through what we know today as the view of the Biggert Waters Flood Reform Act of 2012. I am Dolores Glass, Communications Manager for Wright Flood, and presenting today will be Ashley Tharp, Training Manager, also for Wright Flood. Just to give you some information on the tools we'll be using here at WebEx. If you put your cursor to the top of the screen, you can see a drop-down box, and the chat tool is there. Click on the chat icon, and please bring the chat box down into your screen, and feel free to put your questions into the chat as we go through. We're going to be sure and answer everyone's questions at the end, but we would prefer to go through the presentation first so that everyone who's on the line can be sure and get the prior information, and then once we do that, we'll be able to answer your questions at the end. Okay, so we're ready to get started, and we do have a large group today. So Ashley, are you there with us?
Welcome. Hi, Dolores. I am here today. Thank you so much for having me, and everybody, thank you for joining us for the presentation. I know these are really big changes, and they're complicated and confusing, so we really do appreciate the time that you're taking with hearing what we have to say today. So let's go ahead and get started. So Dolores,
okay,
are you going to hand it over to me?
Yes,
there
I'm passing control over to you, and you're on your way.
Okay, thank you.
Mm-hmm.
There we go. The Biggert Waters Reform Act of 2012 was signed into law July 6, 2012. This was a really good thing that happened because the most important thing for us was the reauthorization of the flood insurance program for 5 years. So we will not have any kind of lapse or any delay with having policies issued or handling policies until at least September 30th of 2017. The current status of Congress, where there's a government shutdown, does not affect the flood insurance policy or the premium collection or the processing for us, where we're having to be able to issue policies and essentially keep going on about our business, which is really good that we're not being interrupted. For the October portions, we do know that some parts have already been implemented in January of 2013, and then we just recently had some other portions implemented in October 1st, and we're probably going to have a lot more questions today about some of these October changes. And then we do know that there's still more to come in 2014, and we'll be talking about what's to come in the future as well today. What we have done so far with this bill in the past, and that was the January 2013 implementation of the exclusion of certain properties from receiving subsidized premium rates. That is pre-firm buildings in a Zone A, AE, those A-rated flood zones, or those B-rated flood zones, or Zone D, like Diamond, would experience a premium rate increase up to 25% annually until they reach those actual or risk-based premium rates. Non-primary residences would be that are single family, where it's not their principal residence, and this would include your condo unit owners, or policies of multifamily dwellings would also receive this 25% increase. Pre-firm buildings are buildings that are built prior to the community's first flood insurance rate map, and they became effective prior to January 1st, 1975. And there has been no substantial improvement or damage since then. A non-primary residence is a building that is not to be lived in by the insured or the insured spouse for at least 80% of the preceding 365 days of the effective date. As of October, there was a rate increase that has impacted business properties, severe repetitive loss properties, and any property that has incurred flood-related damage in which the cumulative amount of NFIP flood insurance claim payments equaled or exceeded the fair market value of the property. These properties that were previously rated with pre-firm rates or those subsidized rates that were in an A zone or a V zone will now experience a premium rate increase up to 25% annually until they reach those actuarially or risk-based rates. And I do want to briefly touch what that means until they reach those actuarially or risk-based rates, what that means. That would mean they're going to continue to get a 25% increase until we receive an elevation certificate and are able to compare the actual premium that is really due for the policy based on the risk assessment of the elevation certificate, or for a D zone, the photos and form. It's difficult to compare what the risk-based rates are without that elevation certificate. So those rates would just go up until they reach the maximum. Oops, is this one I just went over? I think it is.
Yes.
So sorry. All right, so no extension of subsidy to new, lapsed, or assigned policies. These will receive full risk rates. That is a pre-firm risk that is new to the NFIP. So if they had previously been with a non-write-your-own carrier and now wanted to have flood insurance through the NFIP, if it is a brand new owner where they're purchasing flood insurance for the very first time, or if it's a situation where a prior owner is transferring that policy over to a new owner, these will not be eligible to be rated with that pre-firm rates as it was previously. They would have to be rated with the elevation certificate and receive the full risk rating. And that elevation certificate would need to have photos, or if an elevation certificate is not provided, tentative rates would be used for those pre-firm risks. For October, this is any new policy with an effective date July 6, 2012 or later, an assigned policy where the assignment took place July 6, 2012 or later, or a lapsed policy where the lapsed new effective date was October 4th, 2012 or later. This applies to all occupancy types, which would be your single family, 2 to 4, other residential, and RC-BAP. There is one exception, and that is gifting or transferring to an estate or trust. If Joe Smith has a policy and he passes and his property is transferred to an estate of Joe Smith, then that would be able to maintain those pre-firm subsidized rates. So we do want to clarify, this is a retroactive underwriting of affected policies. That effective date of when this was to happen was July 6, 2012 up until October 1st, 2013. That means we have to go locate these particular policies that are affected, and at their first renewal after October 1st, 2013, we send a notice to the policyholders regarding the additional information for their renewal. This should be going out between 100 and 120 days prior to their expiration, and then a non-renewal notice if we do not receive the necessary documentation. This would also go to the insured, the agent, the mortgage company, and this would be 70 days prior to expiration. And then again at 56 days, and then a final notice sent on that expiration date. So, and again, if you had a policy that was brand new, that now had previous coverage, if it had been assigned or there was some kind of lapse, then if it initially became effective July 6, 2012 until October 1st, 2013, these are going to be subject to these new rules where we're going to have to collect that elevation certificate. So what does this letter state? For the insured to maintain NFIP coverage, supporting documentation must be received with the full premium within 30 days of that expiration date. Now that is 29 days plus the expiration date. So when you're calculating, please make sure that you're including that expiration date in that 30 days. We would need an elevation certificate for flood insurance, 2 clear exterior photos of the front and back of the building to be insured, a renewal application completed and signed by the agency, and the annual premium determined with the full risk premium rates or those tentative premium rates. If you are submitting this information after that 30-day grace period, policy would be treated as new business and subject to any waiting period that would now apply. The no extension of subsidy to new, lapsed, assigned, or policies receiving full risk rates will be this will be affecting all your Zone Ds, and where they will need to be rated using the Submit for Rate tables to allow full risk rating. Again, this would affect any new policy with an effective date July 6, 2012, an assigned policy where the assignment took place after July 6, 2012, or a lapsed policy where the new effective date of the lapsed policy is October 4, 2012. And again, this applies to all your occupancy types, your single family, RCDAP, non-residential, and the one exception still being if it is transferred to or gifted to an estate or trust, then that would be allowed to maintain those subsidized premium rates. They did make a change to the annual limitation on premium increases. As of October 1st, 2013, the maximum premium increase allowed under the NFIP is increasing from 10% to 20%, and this would be based on the various rate classes that we have. October 1st, 2013, the average rate will be 10%. This applies to all of our occupancy, all occupancy types, all your flood zones, and all dates of construction. So your pre-firm, your subsidized rates, as well as your post-firm actual risk-based premiums. We will go into what exactly that percentage increase means in a bit, but just wanted to let everybody know that change of when you're budgeting did change from 10% to 20%. Dolores, do you want to continue on?
Okay, yes I will. Thank you very much. So Ashley's been talking to us about the things that are going into play for October 1 and current. But one of the things that is mentioned in the BW12 law that is not necessarily going into effect right now would be the installment payments. Installment payments are going to be implemented at a later date, even though they were part of the Section 205 that is being implemented October 1, because it requires so much rulemaking that it's going to take 2 or so years for the NFIP to develop the rules that it will take to put the installment payment options into play. They did, however, as of October 1, establish a reserve fund. The reserve fund is a separate account put together by the NFIP where they're trying to collect premium amounts that will be used for future claims. The entire amount, 5%, they're going to use as a surplus on top of all of the premiums, will be used only to pay for future claims. So it won't be used for any commission payments to the agent or expense allowance to the Write Your Own company. So that reserve fund that we're talking about will be effective October 1, or was effective October 1. It's 5% applied to all flood policies except preferred risk policies, the regular PRP, the PRP extension, and the group policies. Those are not subject to the 5%, but everything else, all the other policy types are, applying to single family, 2 to 4 family, other residential, non-residential, all flood zones, all pre- and post-firm buildings, are subject to this reserve fund. The only ones that are not getting it would be the preferred risk policies. And this 5%, again, is a separate cost calculated based on the total premium after the deductible impact, ICC premium, and the CRS discount. So that reserve fund will be shown on the declaration pages currently. Also, now we're going to talk a little bit more about what kinds of things are going to be coming up into the future. Sometime in 2014, we expect that Section 207 will be implemented, and 207 is mostly about the elimination of grandfathering. This is the section of the bill that has currently been a lot of discussion where members of Congress are trying to make amendments to the bill related specifically to the grandfathering. This means that FEMA is planning to adjust the rating of all policies after a map revision or a map change to accurately reflect the current flood risk. So right now, after a map change, there are some situations of grandfathering rules that would allow someone to maintain their flood zone rating or maintain the BFE where that their property was built to match and get a grandfathering discount. Well, starting sometime in 2014 when they enact Section 207, the grandfathering will be eliminated, and after that policy suffers a map revision or map change, then they will start to charge risk-based premium for that policy based on the map that is current at that time. And when they do that, they're going to again enact a phased-in program where for 5 years they're going to phase in those policies that are affected by a map change and therefore moving up to risk-based rates. They're going to phase that in at a 20% rate each year until they reach the actuarial base or risk-based rate. Now, they would need to have an elevation certificate to be able to know what that risk-based rate is, and some of those properties will have an elevation certificate, not all of them, but they will no longer be able to be rated using the grandfathering considerations. Also, Section 204 is going to be implemented some point in the future. They don't have a real date at this point as to when these next sections are going to be implemented, but the considerations would be for a multifamily properties of 5 or more residences up to the limits of business properties, which means that they're going to increase the amount of coverage that the NFIP will offer for multifamily properties up to $500,000 for the building and $500,000 for the contents, similar to what they would do for commercial properties. Now, again, this is not quite scheduled for implementation yet, but they are thinking about increasing the amount of the coverage for multifamily properties. Also, there's going to be changes to the deductible limits. They're going to have a tiered effect for the deductible limits at some point when they enact this piece, setting minimum pre-firm deductible limits of $1,500 deductible if your coverage is $100,000 or less on building, and a $2,000 deductible if the coverage is over $100,000 for building. The minimum post-firm properties will also have deductible limits, will be $1,000 minimum limit for coverage of $100,000 or less, that's building coverage, and $1,250 deductible if the coverage for the building is greater than $100,000 and you're in that post-firm level. So those are some of the things that are still up for enactment. The next part to be implemented would be the lender considerations. There's going to be some changes to the lenders part that are part of the BW12. The first part will be the enforcement. Lenders are required, it's mandatory that lenders put flood insurance or make sure flood insurance is put in place on properties when they're lending federal loans as mortgages for those properties. And the fines, if they fail to meet that requirement, are going up as a result of the BW12. In the past, the fine was $350 per violation, and now it's going up to $2,000 per violation, or I shouldn't say now, when we implement this piece. It is not yet determined when that implementation will be. Another lender consideration will be the escrow of flood insurance payments. It will be for any mortgage outstanding or entered into on or after July, let's see, what does that be? July 6th of 2014, will be required to have an escrow of flood insurance by the lender. And also the lender will have some new flood insurance availability requirements for RESPA, so that the lender must make an explanation of flood insurance and the availability of flood insurance under the NFIP program or from a private insurance company must be made known to the borrower, whether or not the real estate is located in an area having special flood hazard areas or not. So the lender has to let the borrower know that they do have the availability of flood insurance and that that availability can be through the NFIP or from any private insurance company offering flood coverage. And then the final piece of the BW12 includes quite a few studies and councils and appeal boards that are being set up to help the NFIP as far as considering future reforms of the flood program. They're going to be studying a lot of the pre-firm structures. They're going to do a GAO report on those to find out how that's going to work and how these new increase in premiums are going to affect that. And also we're going to see major studies about the reinsurance and the privatization initiatives going through the NFIP. So we're now ready for the questions, and that means we're back to you, Ashley. Let me pass this one back.
Okay. There we go.
All right.
So we have some frequent, yeah, I think I do.
Good.
Make sure.
Okay.
Yes, I do.
Very good.
So we have some frequently asked questions we're going to go over, but then we're going to start taking your questions. So if you want to start going ahead and sending those chats over to Dolores, she can get them organized and ready to go and ready to put me on the firing squad.
Okay.
All right, so first one, what if a non-primary home becomes the insured's home for the primary home for the insured? This is fantastic news. We just need to get an endorsement request. We can make that change for you, and sometimes if we have already charged you for the higher premium for not having a non-primary, it can end up being a refund for the insured. Likewise, if the insured has moved out and the risk is no longer their primary residence, we would just need notice of when exactly they did move, and we would do an endorsement. There would be an additional premium due for that particular change if the risk is pre-firm rated, and then we can go ahead and issue that policy for you that way. And it's a simple endorsement to the policy. And this is something that can be done online as well. Our non-primary homes and non-residential buildings that are in a B, C, or a non-special flood hazard area subject to the 25% increases? Very fun answer for this is no. These are standard rated and PRP policies are risk-based rates, so they are not subject to the extra 25% increases. If you have a preferred risk extension policy, although these are not actuarially sound rating where they should be rated with an elevation certificate or rated based on the current mapping, their risk will increase 20%, and that is effective October 1st, 2013. And just a reminder, the difference between a regular preferred risk policy and a preferred risk extension policy is that the extension policy is a property that had a map change on or after October 1st, 2008, where their flood zone went from a B, C, X, or D to a special flood A zone or V zone. And they also would have to qualify based on loss history. What are tentative and provisional rates? This is a really good question because we keep talking a lot about tentative rates and provisional rates. These are temporary rates that we can assign to a policy if we do not have the needed rating information to provide the risk-based rates. So that would be your elevation certificate and photos, maybe some building information. So if that information is not able to be obtained in time to get your renewal offer or to process a new business, we are now going to be able to issue you a quote with those tentative rates. These caveat with the tentative rates or provisional rates is these policies cannot be endorsed to increase coverage limits or renewed for another policy term. So that does mean we do have to have, that's only 1 year possible, and if there's a loss during that year, then that means we have to collect that elevation certificate. We cannot issue your loss payment or process your claim until we actually have the elevation certificate and photos in order to process it, to process your policy. In addition, there is a difference with provisional and tentative rates as well. Even though the rate structure is the same, there is a little bit different of when the elevation certificate is submitted and how the policy can be endorsed after that elevation certificate is received. In addition, provisional rates are only eligible for post-firm rating, or post-firm building. So your building would have to be a risk that was constructed after 1975 or after the map revision of the community. The insured is being rated pre-firm but has an older elevation certificate. Does the insured have to get a new elevation certificate? Again, a very, very common question we hear, and one that we really do like to say, if we have an elevation certificate, unless there has been substantial improvement or major changes, or it's missing important information in order to determine the information, we really do make every single attempt to use that elevation certificate. Sometimes if there's been substantial improvement, we would not be able to use that elevation certificate because it's not based on the risk that's there now. In addition, there are requirements on all these elevation certificates, such as it has to be signed and dated by a licensed engineer or surveyor, and if that information is not available, then we would not be able to accept that elevation certificate. We also want to let everybody know if a community is receiving a CRS credit, and this is known through the community whether or not they are, but if they are, they're required to keep copies of their elevation certificates and flood proofing certificates they receive on or after the date the credit was first provided to that community. So that is a really good place for an insurer to check before purchasing a new elevation certificate, because sometimes they do have it there and on file. Let me see. Oh, there we go. What if a pre-firm rated policy lapses as the mortgage's check was not received within the 30-day grace period? Will there be an exception as it was not the insured's fault? And we are not able to grant exceptions for this reason. In the case of the new effective date due to a lapse is on or after October 4th, 2012, then we would have to have a new elevation certificate to rate that policy. Otherwise, we would have to use tentative or provisional rates. The only exception we would have available is if a community is suspended from the NFIP and then later reinstated. The subsidized rates can be used if the application and premium is received within 180 days of the community reinstatement date. This is a really important thing for insureds to know and to understand, especially since if they're relying on their bank to make that payment. If the bank does not make the payment within the time frame and they're going to have a lapse in coverage, that could mean that they're now subject to risk-based rating and having to submit that elevation certificate in order to have their policy. It's a very important thing for insureds to keep on their lenders about to make sure that that payment is made in time. There we go. What if a pre-firm rated policy is assigned to an estate or trust? Can they continue being rated with pre-firm rates? Yes, as long as that initial policy was issued prior to July 6, 2012. For a further example of this, if I had a policy and for the last 5 years and as Ashley Smith, and I decide I want to go ahead and transfer it into my daughter's name, for my daughter, transfer it into a trust fund for my daughter. Then I can transfer all of this, all these assets over to Ashley Smith Trust, and there will still not be any kind of change to how the handling of that policy would be. It would still be pre-firm rated. There it is. What happens if the insured cannot get an elevation certificate before their renewal? And I'm going to answer this in 2 different ways, because you have their first renewal that we're going to issue after October 2013. If the first renewal after October 2013 does not have an elevation certificate and one was required, then that policy can be issued with the tentative rates. These are only available for the first year and prior to the for the renewal. And again, the policy could not be renewed without the elevation certificate, and if there is a loss during that year, that elevation certificate information would be required in order to adjust the loss. Now, if it is the first policy, the term after that year, so it's your first policy, your first renewal after October 2014, so this is next year, and they're still not able to obtain an elevation certificate, that file would end up being non-renewed. They are only eligible for 1 year of tentative rates, and then they would have to go out and obtain that elevation certificate in order to have the file rated with the correct rates and the correct premium. Will rates increase to 20% due to the annual premium rate increases that changed from 10 to 20%? The average rate increase is only 10%, and the premium for a particular policy may change more or less than the increases noted below. If you have a risk that you are aware of the particulars for how it was rated, you have the elevation certificate, you have the file, you have the information. If there is a risk that you're wanting to know what their changes are, then that risk needs to be, you need to contact the company in order to ask what the change will be to that particular premium. Sometimes for one rate structure, such as those V zones, if you are a +4 versus a +1, the difference in premium and difference in rating from 1 year to the next is not the same as what that percentage increase would be listed on here. That is an average of all of those premiums for all of those rates. So it's not something that you should just blatantly, blindly say, here you go, this is the new, it's going to go up this amount. Some will go up more, some will go up less if you have particular rating information. So if you know that, a particular risk, and you have the file, definitely call the company to see what that increase would be. If you don't know and you're just trying to give an estimate, then that's a good estimate. That percentage does include the 5%, Dolores, I keep forgetting the name. Yes.
Reserve
fund. Thank you. It does include the 5% reserve fund. So when you're looking at these post-firm increases for your A zones, your AH, that's only 6%. So 5% of that 6 is your reserve fund. 1%, so the rate only changed approximately 1%, which is the federal policy fee change. Same thing with that PRP rate structure. If it's a regular PRP, that 1% is only the federal policy fee changing. But the PRP extension did go up the full 20%, and that is definitely more than that federal policy fee. That is a real rate increase that occurred on that policy. Will there be any other changes effective October 1st that are not part of the Biggert Waters Flood Insurance Reform Act? Yes, we do have a few changes. One I just mentioned is the federal policy fee did change from $20 to $22 for those preferred risk policies, and $40 to $44, or the equivalent multiples for your RC-BAPs. And this is for all policies with an October 1st, 2013 or later effective date. Your lender required waiting period is now subject to a 30-day wait effective October 1st, 2013. This will affect your MP3 policies or policies that are purchased after a closing at the lender's request. So if you have a policy and they're going to closing and the lender is requiring flood insurance for their closing, that is a loan closing waiting period. You can still have the closing date as your effective date. If you have a policy, if you have an insured where they went to a closing, they closed, and now the lender is now asking for flood insurance to be purchased after the closing has already taken place, that is a lender required waiting period, and that is now subject to a 30-day wait. New business endorsement and cancellation form changes, these have already been implemented in our online system, and these are in the form of additional questions that have been required. There has also been a change to flood proofing and underwriting documentation changes. If it is a renewal policy with an October 1st, 2013 or later effective date, if it is a new business policy with an October 1st, 2013 or later effective date, we are requiring additional information that needs to be submitted to the NFIP for them to grant approval for the floodproofing credit to be applied. If it is a renewal with a December 1st, 2013 or later effective date, then the renewal may go out without the floodproofing credit because we will be required to re-underwrite these files and obtain the necessary documentation for the floodproofing credit, and that has to be submitted to the NFIP before the credit can be applied. Does the lender required 30-day waiting period apply to loan closings? No. The loan closing is a different waiting period, and that can be for policies that have your BC and X zones. If you're going to a closing and you are wanting to purchase flood insurance, even if you're not being required by your lender, you can have that effective date of your closing as long as you pay and you apply and purchase the policy prior to the closing. If you have already closed on the loan and then you're, because of a map change or the some kind of review that the lender did later on and then determined that you were required to purchase flood insurance, that is called lender required, and that would be subject to the 30-day waiting period. We haven't talked anything about a map revision waiting period, which is a one-day waiting period. And I suspect this is going to be utilized a little bit more in the future because typically we have a lender required waiting period being used in the past, which would waive any wait. And now if the flood insurance is being required because of a new map change, more than likely that lender, the map change waiting period, which is only one day, will probably be your best bet. All right, so let's see, do I have one more question? Oh, okay. Are policies no longer allowed to be assigned? So yes, policies still can be assigned. But if they are rated with that pre-firm in a special flood or zone D, then they would be endorsed prorated with an effective date of the date of the purchase, and they would have to be utilizing the current mapping information and elevation certificate information to rate them. So in the past, we would say a policy got reassigned, we would just change the name and issue the file, and then that would be it. There would be no premium due or unless you were making a change to the coverage. Now with the changes to how we're able to handle these, if a policy does get reassigned, then we would need an elevation certificate. We would need to know the current mapping information, so it would require complete underwriting of a file if you were going to assign a new policy, and that could cause an additional premium to be due as well. So that it's definitely something to look for. Usually it's a better idea just so that they can have a 1 year full premium to know what that is, just to go ahead and do a whole new application. Sometimes seems to be the easiest way. But if you happen to have all of that elevation certificate information in order to re-rate it, then you certainly can still do that reassignment. What would the premium be if a new map changes the flood zone from an AE to a VE zone? And this is pre or post firm. And the rate will vary a pretty big deal, and it depends on the type of building, the coverage, your occupancy, and the rates, though, for an AE zone versus a VE zone are drastically different, and it is typically a much more expensive policy, that VE zone. They are a higher risk and typically something that is really next to the water, and it's a velocity zone. So the risk associated with those rates are quite different. In addition, there's different building requirements and rating requirements that go into the VE zone versus the AE zone. FEMA is still looking into how they're going to actually implement this, and it is over a year away, and so the section of the bill could be reformed if we ever get the government back in office. Then that would be the biggest thing that you're waiting on, is how exactly are they going to be making the change and impacting the policy for when there's a future map change, and how they're going to address that. That is the big question that we're waiting on the answer for right now. If you have an insured that is very concerned about this, then the only thing we have is what they are doing right now. And right now they would be eligible for some kind of continuous coverage if they purchased before, and they would be eligible to have grandfathering for built-in compliance as of right now. However, this can change, and we are expecting it to change, and those rates would go up dramatically if they are affected by a map change that occurs on or after July 6, 2012. So that is something the insured would need to be prepared for if they're deciding to purchase a home on the water or a place that is already in a special flood hazard area, what that could impact them.
Very good.
Okay.
Thank you very much, Ashley. Now we're on to the questions via the chat. And the first question is kind of an interesting question. The person was obviously listening very carefully and mentioned that earlier in the presentation we said that pre-firm subsidized properties would be increasing 25% until they reach the actuarial or risk-based rate. And then later on we said that the annual premium increase from the NFIP had been increased from 10 to 20%, that these two amounts of money seem to be in conflict with each other. So can you help explain why one group, the pre-firm group, is going up 25% versus the other, the second group, which is the one subject to the general annual increase, is going from 10 to 20?
Sure. That is actually a very good question because I don't think we clarify so much. There is a group of policies that are not your principal residence policies. They are your secondary owners, your vacation homes, your businesses sometimes, the non-residential policies that are being rated with those subsidized pre-firm rates. Those are getting an additional 25% rate increase to their particular rating, and that's going to have an increase every year. And that is separate than the regular, this is an AE zone, and these are their rates. It's a separate rate increase that is going to affect them.
The second group is not necessarily the subsidized ones. It basically speaks to all of the rates for the entire program.
True. And so it would just depend. Do you want to pull, can you pull that one slide that has the percentages for all the groups?
Okay, yeah. Yes, I will look for that.
There it is. Okay, and so here we are seeing, if you look in the table that has pre-firm increases, if you have a risk that is a secondary home and in an A zone right now that is rated with the subsidized pre-firm rates, then not only are they going to have a 16% increase, they're also going to have a 25% increase to them. So they're going to be slightly different. They're going to have a more dramatic increase to them because of they're going to have a regular rate increase plus the amount that is for being a non-primary residence. If they were a residential building and it was the primary residence, then they would, and they're still rated with those pre-firm subsidized rates, they would only be subject to that 16% type of rate increase. And if they were post-firm, they would not be any part of that 25% because they're already rated with risk-based rates, and then they would only be subject to whatever rate increase that is being affected for the rates overall.
Okay. So I think we understand the two different categories there.
Right.
The next question is related to grandfathering, and we have several questions related to grandfathering, and I'll try and put them together. The first one is regarding grandfathering and the new maps. If a residence was built in 2005 in compliance with the maps at that time, and the lowest floor was above base flood elevation as was required, and the maps were changed and reissued in 2014 and reflect the lowest living floor is no longer above the base flood elevation. Obviously, there was a BFE change on that new map. The flood insurance and premium, would the flood insurance and premium be re-rated subject to the new maps and rates?
That is a future change, and that's something we do expect to happen in the next portion of the bill being enacted. Part of the bill does state that we should be rating based on the current mapping all the time, and that is essentially the elimination of any kind of grandfathering. But that is in the future. That is not now.
Yeah, and we don't know how they're going to implement that at this point.
And we don't know if that's going to be.
That's the way it appears, but we don't know for sure how those implementation rules will take place.
Exactly. The only thing I can truly answer to with any kind of real authority is that as of right now, if you submitted that and you said this is a grandfathered, here's your map information from when they were built, and here's my application, we should issue that file with your grandfathered information provided it qualifies for grandfathering. And so as of right now, they're still eligible. I've always been one of those people that if I can find grandfathering, I try to stick it in there and give the customer the benefit, because at the very least you have a year or so of good savings, and then at least some time to kind of adjust or make some changes to mitigate potential increases there.
Okay, so here's a related question on grandfathering. What if the risk was grandfathered and was supposed to stay into effect until 2014, but the lender is requiring the policy show the higher rated zone right now? How does the agent help in that situation?
More than likely, the risk is not identified as grandfathered on the declaration page, and so we would need just an endorsement to identify the grandfathering. Most lenders do accept the grandfathering. I have heard of a few that did not, or that argued the eligibility of grandfathering for particular risk. When this happens, we do make an effort to actually call the lender ourselves directly to go over it with them, or we'll, if the lender doesn't want to talk to us, then we have another option too that we'll utilize, but you kind of have to get up to a supervisor to kind of get into that discussion when that occurs. Or get to your RSM to talk to them about that occurring because there are other options there. The other situation is if you are PRP, a regular preferred risk, and you were not identified as really being a preferred extension policy. And in that case, it's an endorsement. We can make that endorsement and make that change for you as well. And typically, they accept that.
Okay. And here's the last grandfathering question, at least those that we have right now. And feel free, anyone, if you want to continue to put your questions into the chat. So this last grandfathering question is, will the elimination of grandfathering in 2014 apply to future map changes, or will this impact policies that are currently listed as grandfathered on the policy?
Again, we don't know exactly how they're going to implement the bill in 2014. So I can't answer that with because I can't predict the future. I wish I could. I'd make a lot of money.
Okay. All right. You'd be rich if you could do that. All right. So let's see. Here's one. This is on a different topic. If the flood policy was renewed in a Zone B, but the new zone shows Zone AE, they received a letter from the lender advising that the policy needed to be corrected to show the AE zone, even though it was originally written as a Zone B. Can the lender require the policy be changed midterm, or do they need to wait until the renewal?
Okay, you're kind of getting a little cut off there, so let me make sure I have the whole question. The policy is currently in a B zone, and was written in a B zone. Yes. And then the lender is now discovering that there's been a map change, and it sounds like it's occurring during the policy term. And as such, the lender is requiring the flood insurance to reflect the new change. I'm also going to assume this is a preferred risk policy because that's when this really is a problem. If this is a preferred risk policy, that means we cannot identify grandfathering, we can't identify any kind of changes or anything like that. So that really is a bit of a problem for the lender in that they have a policy that is eligible for preferred risk. It will show as preferred risk, and they cannot get their special declaration showing their flood zone. We actually have a letter that says to the lender, this is a preferred policy. They are eligible for this policy until expiration, and at expiration, they will go into the preferred extension or they'll go into grandfathering, and at that point. And we have a letter that we send the lender, we have a letter that we send the lender that indicates this. Typically, that does work. I have had many of those come back and say, okay, great, thank you so much. If it doesn't, then again, it's a phone call or it's you having to get into touch with somebody at the lending office that has some authority to make a decision and to explain to them why we shouldn't do this to the insured. Ultimately, it's not a good thing. If you were referring to a regular policy that is in the B zone, it had been grandfathered previously when it was applied for, and there have been other map changes, and so now this is just the newest one, then that is a different scenario. We can just add the grandfathering, and that would appease the lender and make them happy. So if it doesn't have an impact on their premium, then we make the change right away.
Okay. And then there's another question about the bank showing an AE flood zone, but our zone determination completed through Wright Flood shows an X zone. And basically that would need to be resolved by doing a recheck and providing that information to the lender so the lender can do another check on their end to find out whether the flood zone is truly an X or whether it's an AE. And of course, we know we have to go by the lender's flood zone, but we also know that if we provide information to that lender and request their compliance officer to do a recheck, they usually will help until they get that resolved.
True.
Okay, so now,
Okay.
Go ahead.
Another option.
So here's another one.
Oh, okay.
Go ahead. Another option.
Another option is to request a letter of determination review from FEMA, and in which case the lender would have to comply with FEMA's determination. And so if you feel strongly about your information, And again, that's using part of what Dolores is saying with obtaining a recheck, getting the documentation to show that it's not in a special flood. And then if the lender is not willing to talk or discuss or come back, to handle this, then sending for a letter of determination review from FEMA, and they can make a determination, and at which point the lender is forced to comply with the FEMA determination.
Right. Next question is, if the insured doesn't get an elevation certificate for their renewal, and the flood is actually required by the lender, so I guess when they didn't get their elevation certificate, that means they never put that renewal into effect, and flood is required by their lender, would the lender be able to force place insurance? And does the lender get an elevation certificate when they do that and charge the client for the cost of the elevation certificate?
The lender does not have to obtain an elevation certificate. They have their own policy, which is an MP3, which is a portfolio policy. And these are rated with the tentative rates, essentially. Actually, I think they're a little bit higher than the tentative rates. And they are for the building coverage only. They are subject to a 30-day wait, just like lender-required waiting period, and they can be renewed in that program. So that is something that we will see sometime, probably a spike in those rates. As looking at some of the rates that we're seeing now, I do suspect we're going to be seeing more MP3 policies come through.
Right. Okay. So here's another one about the lender requirement. Does the July 6, 2014 requirement of lenders to escrow for flood apply only if flood is required by the loan? And my understanding is that that is true. What do you think, Ashley?
Again, I'm not really sure. I read it as that if you had flood insurance, that they were required to offer the escrow. That so that some of them, what they were doing is saying, you have flood insurance, and even though you're in a preferred risk, then we are not going to escrow that, and even though you want it. And so I interpreted it as they were required to escrow, or required at least to offer. So I could have misinterpreted. So, but until 2014 and they implement, we don't know.
And the last question I have is, if a policy is paid by the insured and lapses, does he still have the 30-day grace period before the elevation certificate would be required?
If they lapse their coverage and they're past their expiration and past the 29-day grace period, then they do need to get an elevation certificate, or they would have a new policy with those tentative rates. And and then they would have that information. Okay.
So I thank everyone for being here today. I just want to say that we appreciate your attending our webinars, and our intentions when we put on the flood webinars is to communicate the NFIP topics or underwriting rules as a convenience to you, our agents, and our policyholders. We apologize if we've inadvertently miscommunicated anything today. We defer all the disputes on NFIP and flood topics to the NFIP guidelines and manual, and of course any FEMA bulletins and official statements on those topics. And the opinions that we've offered today are our own, not representative of Wright Flood, NFIP, or FEMA. And if there are any further questions, Wright Flood Marketing and your regional sales manager is available to assist, and of course you can always call your team. One of the questions we've received today is can we share copies of the slides? And unfortunately, we won't be sharing copies of the slides, but what I will be doing is sending a thank you email out to everyone to thank you for attending today, and I'll also be including all the handouts that were available for today's webinar. They will be attached to that, and you'll find that the handouts do represent pretty much all of the information that we've given out today, except for, of course, the verbal piece. So we are still having 2 more live presentations of this webinar, which will be Wednesday the 23rd and Wednesday the 30th of October, both at 1 o'clock. So if anyone would like to still register or anyone in your office would like to register, they can go to our website and register. There also are on-demand webinars available there with other flood topics, specifically how to handle flood zone disputes, which was a topic we covered in our chat today. And I think that pretty much covers all of our information. On behalf of Ashley Tharp and Mark Glass, we want to say thank you, and we appreciate you choosing Wright Flood for all your flood insurance needs. Thanks again for joining the webinar. Goodbye now.
Thank you. Bye.
Bye-bye. So long.